Right, great to see everybody. So I'm going to do something fairly unusual here because basically almost every professional trader that you meet has an enormous ego. So basically we tend not to talk about our losing trades. We only tell you about the winners. So I've got to eat a bit of humble pie, and I'll get the confession trade out of the way first, and then we'll end on a high note. But as with life, clearly we learn more from things going wrong than we do from things going according to plan. So actually, talking about losing trades is not just a cathartic thing to do, but it's also extremely useful, and that's where we're going to learn our best lessons from. Just a sort of a general point as well. So some of the students get very upset when they have losing trades. They seem to come along thinking that they need to have, if anyone likes football, they need to have like a sort of an Arsenal type season where there's no defeats at all. And that is just completely unrealistic. In fact, I was talking about it with Chris last night. We reckon that if you get 60% of your calls right and 40% wrong, that actually makes you a very good trader. So do not expect to be getting 8 or 9 wins out of 10. It's just not going to happen. What is important is basically how you deal with your losers, and what is much more important is what Anton already touched upon, which is constructing the portfolio efficiently and properly, and understanding the risks that are inherent in what is in your portfolio, and being disciplined with the structure and the way that you actually trade your positions. That is going to be far more important than just being right. Okay, so onto my losing trade. What we tend to do as professionals is we've got an overall kind of investment outlook in terms of, let's say thinking about what we think is going to be happening in the next 3 to 6 months, and we'll basically drill down from the highest level from a kind of a macroeconomic perspective, and then we'll drill that down into industries and sectors, and then once we've gone through that process, what we'll do is we'll try and find a way to represent the conclusions that we've come to based on that top-down process in, let's say, a single stock or a pairs trade, or whichever way we're going to use to express that idea, and that is the bottom-up part of it. So basically, this trade, both of the trade examples that I'm going to give you are actually from quite a long time ago. That doesn't matter. They just happen to be around about the same time by coincidence, but the principles are clearly still going to apply. So this idea, we had on the desk basically a top-down view where we were bullish on the commodity super cycle. In particular, we were bullish on the oil price. Now, to put that into perspective, at the time that we started looking at this trade, I think the oil price was sort of around the low 20s. So if you think that 26 bucks is low, you ain't seen nothing yet. Chris and I probably can remember oil being down at 10 bucks at one stage. So we were looking at the commodity super cycle, which of course is now a thing of the past. And we were particularly looking at oil. And being traders, we can't do things in a simple way. We were looking to find the biggest bang for our buck that we could. So rather than just buy, a plain boring, sort of large, diversified company like Royal Dutch Shell or BP, we thought, well, we'll go and look at the E&P companies, so the exploration and production companies. And to make matters even more highly charged, we'll go and look at the junior market, so the small to mid-cap kind of range of companies. So we came across a company which is called Regal Petroleum, which actually is still listed. I looked at the price the other day. It's currently about 2 or 3p, I think. And is a completely different company to what it was, but it still managed to survive somehow. So, so basically, AIM stands for Alternative Investment Market. It's the junior market to the London Stock Exchange. It's cheaper, basically, if you're a company, it's cheaper for you to list on AIM. But also, the reporting requirements, so the financial reporting requirements, are a lot lower, a lot less onerous than they are on the main market. Now, of course, that doesn't mean that you can lie and be fraudulent, theoretically, but it's a sort of more relaxed version from a regulatory perspective. So we discovered this stock called Regal Petroleum. which was trading on the AIM market. And at one stage, actually, it became briefly the largest company by market cap on the AIM market. And as I say, this was the way that we were going to represent our top-down view, our bullish view on oil. So what was Regal? Regal basically was an E&P company. They had 3 oil fields in Greece and some gas condensate fields in the Ukraine. So they had the 3 fields in Greece were called Prinos, Epsilon and Kallaraki. So basically P1 means that you've had your reserves audited independently by geologists normally, and the P1 refers to the proven side of your reserves. So what that actually means in practice is that there's a 90% confidence that your reserves will result in actual oil or gas production being produced. Now P2 is probable, and as the word suggests, that's subject to a lot more uncertainty in terms of whether you'll actually end up getting those reserves out of the ground. And actually what it refers to in terms of a probability is a 50% probability. And there is actually a P3, but that's obviously an even lower probability of getting the stuff out of the ground. So basically Regal had an implied valuation of its P1 and P2 reserves of less than $1 per barrel. So think about that in terms of where the oil price is now, where the oil price was at the time in the low 20s when we started looking at the trade. And that was compared to the peer group, which was trading on around just over $4 per barrel of P2. So clearly the company is already trading at a discount to its peer group. And when you put in if you just looked at the P1, so obviously a much higher probability of extraction, it was trading still at a discount to its peer group of around $3 per barrel. So as I say, once we included the P2, which was basically the 96 million barrels of oil that were in this particular field called Kallaraki, you're looking at a very highly discounted company compared to its peer group. And as I mentioned, they had also the gas condensate assets in the Ukraine. Now, we took a 3 million quid position in the stock. That's not a big position at all for a proprietary trading book at a bank. However, because this is a small company, that was at the time the equivalent of 5% of the company, which is, that has implications in terms of liquidity and trading the position. So in terms of the story, so we started looking at this stock at the end of 2003, started building the position end 2003, coming into 2004. First half of 2004, they made a very promising discovery in this Kallaraki field, which basically led to the management. Now this is quite a crucial point here. The management upped their estimate of P2 from 96 million barrels to 250 million barrels. So that is obviously an enormous increase. Now the crucial aspect here, and I can hear someone sniggering over there, and what's quite amusing about this is that when I started going through this trade for the presentation, I actually started thinking to myself, I cannot believe that we did this trade. I mean, when you actually go through it, but we all get carried away sometimes, and we make mistakes. So the management upped their estimates, but this was not independently verified or audited by the geologists. However, they made announcements to the stock exchange. You work on the basis that when a company makes an announcement to the stock exchange, that they are at least somewhere near close to the truth. They also forecast that they would, once they drilled enough holes and basically got into full production, that they could be producing up to 25,000 barrels of oil per day. Now think about that in context. The most this company ever produced at its peak was 4,000 barrels of oil a day, which is pathetic. So they were saying, we're upgrading this asset from 96 million barrels to 250 million barrels. and at peak production, we're going to be producing 25,000 barrels of oil per day. So think about that. At $40 a barrel, that's $1 million of revenue every single day. And this is a small cap company that when we started looking at it, I think the market cap was probably about 50 or 60 million quid. So, you can do the maths. Basically, we were in this thing, we had about just over 1 million shares in the stock. We were in at an average of £2.50. When we started looking at it, it was below a quid. And the price peaked in early 2005, and I'll show you the chart later. The price peaked at 5 quid. So when it hit 5 quid, we were sitting on £3 million of unrealised profit, so the positions basically doubled. As I say again, it's not a massive P&L, but in percentage terms, obviously, it's a great return. And I would forgive you for asking yourselves, well, why did you not sell at that point? Which is a very good question. And the answer to that question is because we, in the valuation that we had done, basically, back of the envelope, we had £7.50 for Greece and £1 for the Ukraine per share, which obviously equals £8.50. If you think something is worth £8.50, why would you sell it at 5 quid, even if it's doubled? That was the kind of thinking. So, what happened? What went wrong? Well, as I kind of stressed a couple of slides ago, the upgrade in the reserves was stated by the management, but it wasn't actually independently audited by the geologists. They did actually have the P2 that eventually was audited by the professionals, by the geologists. It did come out somewhere around that number, but the unfortunate aspect was that you might have reserves, but you've got to get them out. And how much is it going to cost you to get them out? And technologically, do you, have you got the ability to do it? So basically what had happened is that the management had obviously painted a very kind of like blue sky scenario, and what they had failed to sort of communicate with the market was actually they didn't really have a plan for how they were going to get the oil out, and in connection with that, they therefore didn't know how much it was going to cost to drill the wells and how expensive that would be. So, I mean, just as a kind of aside, eventually, this didn't help us with our trade, but eventually the company management and the CEO were censured and fined by the London Stock Exchange. So they were never criminally implicated, but they were actually censured and fined by the Stock Exchange, which is about the sort of strongest thing that they can do. Now also, this is probably should have come as a hint to us as well. Now clearly when you find a big load of reserves, you've got to raise the money to drill the wells to extract it. So they actually raised over 100 million quid around the beginning of 2005 at £3.90. So unfortunately, once they started drilling, the first 2 wells that they drilled were dry. Now what that basically means is that they had hydrocarbons which were flowing, but not in commercial quantities. And when you read that, it sounds like a fairly innocuous sentence. You read the first part and it says hydrocarbons were flowing. That's good, sounds good. But then not in commercial quantities. And this comes out generally at about 7:59, a minute before the market opens. So you can imagine what happened to the share price. Initially, what had actually happened was the stock had run up to 5 quid at the beginning of the year. The company took the opportunity to then place a lot of stock at 3.90. So the stock price kind of drifted back from basically around 4 quid to sort of 2.75. And then after the announcement of the dry well, the 2 dry wells, it went in a straight line. It basically opened at a quid. So it went from 2.50 to £1 in a straight line. No gap and no opportunity to sell any stock. So, when you're dealing with the sort of fallout of that, clearly, okay, the P&L's taken a hit, that's bad, but you've got to sit there and work out what the hell's going to happen, what is left to salvage from the situation. unfortunately, in this case, not a great deal, because basically the whole valuation was really based upon the Greek fields, and clearly when you drill not one but 2 dry wells, then the whole commerciality of that field is obviously completely under question. There was, as I say, there was still a bit of residual value left from the Ukrainian side. We had that valued at £1. Clearly the market is just not willing to give any kind of credibility or, let's say, benefit of the doubt in terms of valuing the company after they've basically misled the market and then drilled 2 dry wells. So then what happened, and this is obviously turns into quite a long and protracted process. You get multiple management changes. Basically, people get sacked. The company then goes from a situation where it did have a plan and it has raised cash to, well, what can they now do to get the company into a much better situation? Well, there's basically only 2 things they can do. They can either try and sell it or sell off the assets piecemeal, which of course is not going to be a great strategy because everybody knows you're in a weak situation. So guess what? The bids are not going to be too high. Or do what's called a farm-in, which is basically get a big brother to come in and help you extract the oil and gas in a joint venture. And actually that's what the company subsequently ended up doing. They ended up having discussions with Shell and I can't remember what the Ukrainian company is called, the National Ukrainian gas producer, but they had talks on farm outs as well. So I guess you're probably all dying to see the stock price chart. So basically, we had started looking at the company around about this time. You can see it was below £1 actually before we started buying. It went all the way up to our average in price. We actually just bought it all the way up and we were in around here, around 250. You can see the peak up here is, the peak's over there at £5. So all the way through 2004, they're basically doing the exploration and trying to get their P2 number up from 96 million to 250 million. They're obviously communicating to the market at the time as well. And then this first move here, that's when they do the placing. And then the next move is probably insiders who know that they've just drilled 2 dry wells, but this hasn't yet been announced to the market. And then the big move there is the straight line move when they actually announce the dry wells. So obviously not a great experience. What do we do with our position? Well, we ended up cutting it around an average of 125. So basically we went from a situation of doubling our money to halving it. The numbers are not really important. It's more the hit to your ego and the fact that you've got to explain this to the head of the department as to why you were such a bunch of whatevers that you didn't sell the stock at £5. And basically it's a pretty sorry tale of grasping defeat from the jaws of victory. But we can learn some lessons, thankfully. So first lesson is just a general thing about the words cheap and expensive. So if you remember, when we first started looking at the stock, it was trading at an implied valuation of $1 per barrel. The competition was trading at $4 a barrel. Well, you're thinking, that sounds good, that's a bargain. Well, maybe there was good reason why the stock was trading at a discount. So basically, stocks, companies can be cheap or expensive for good reason. In this particular case, obviously there were some people in the market, and also, by the way, I know somebody who was short of this at my old firm, which made it even more galling, and of course, which he massively enjoyed telling me about once the trade had gone his way. He wasn't looking so good at £5, but anyway. But obviously he and others had worked out that actually, do you trust this management in terms of not necessarily their their honesty, but do you trust this management team with £100 million of shareholders' money to actually do the right things, go through the right process to extract, that oil is still there, it's just probably never going to get extracted. You could argue that when the company was itself selling stock at 390, maybe we should have taken the hint there. If they're prepared to sell stock at 390, how realistic is your £8.50 valuation? General point about trading, just, if you think about it, trading is, stock markets are basically a derivative of economics. How do we get that top-down macroeconomic view? Well, we're looking initially at the investment picture, which comes from what do we think is going on with US GDP or with the commodity super cycle or the Chinese economy, whatever it is. Now, economics is a social science, right? It's not an exact science, and trading is a derivative of a not exact science. And trading and investing, as you've heard many times, is often about fear and greed. So in this particular case, obviously, we were not just greedy, but we were also probably guilty of hubris as well. And that is something that you definitely need to be aware of and avoid as a good trader. Falling in love with positions. I've got students that have done it. I've done it myself. You just become very one-eyed about a situation. You can't be objective. And that is something that you've always got to guard against because it leads to bad judgment. In terms of the sizing, even though it was only initially a £3 million position, it was too big because basically when the proverbial hit the fan, obviously we couldn't get out of it. It took us weeks to trade out of it. So you need to be aware of market liquidity and obviously size your positions accordingly. Small and mid-cap companies do have potentially greater reward profiles, but of course with greater reward comes greater risk. So you always, as Anton was referring to in terms of, it's not just about generating good returns, it's always about risk-adjusted returns. How much risk am I taking to make my returns? In the same way, when you look at a small or mid-cap company, you've got to be thinking about not just the upside, but also what the potential downside is. And obviously it can be fairly horrific. And I guess, a general point about this particular size of company and the sector, it's known as a sector that is not for widows and orphans. And that's for very good reason. So, and also the other aspect to bear in mind about these types of companies is that they're often referred to as lifestyle companies as well. So if you think about a management team that's gone from their market cap being, let's say around 60 million quid to then raising 100 million pounds in cash, and that's sitting in their company bank accounts, well, how much do you trust them to actually utilize it correctly? I mean, when we were at Commerzbank, I remember a company management turning up. This was, again, another small cap. And basically, we heard when they turned up at reception that they were in a Maybach. And basically, once we heard that, the meeting didn't need to take place. We took the meeting, of course, but once they've turned up in a Maybach, that tells you all you need to know about how that company is run. Okay, so that was the horror trade. So onto the good news story. Now this was actually, just by coincidence, this was round about the same time, sort of 2003, 2004. We had done a bit of sector and industry analysis on the US wireless sector. And so basically there had been quite a lot of consolidation taking place in that sector at the time. And we wanted to put a trade on which was essentially making a bet on further consolidation within the US wireless telco sector. Now, just to give you a bit of background, so I'm sure you've all heard of AT&T. AT&T used to be a much bigger company. It was previously almost a monopoly company, which ended up getting broken up by the Department of Justice in the early 1980s. And as a result of that breakup, they created 7 what became known as baby bells, The bell refers to the trademark, the symbol of the company. The telephone company is actually a bell. And they were known more formally as the RBOCs, the regional bell operating companies. Now there was a JV created between two of them, a joint venture called Singular, which was created to take advantage, to build a position in the US wireless telco market. At the time, AWE, which is the ticker for AT&T Wireless, was the third largest wireless company in the US, had a very large network, but unfortunately that network was in need of a lot of investment to bring it up to speed. So basically we looked at that as it's a company that potentially was in a very good strategic position, and given that we had taken the view that we thought that there'd be consolidation in that sector, we thought that that was one of the companies that could get taken out, and it also had the because of its size, because of its critical mass, we thought it would be attractive to particularly to foreign companies looking to build a position in the US, because at that time US wireless was actually running quite a long way behind mobile telephony in Europe and Asia. And so not only were their penetration levels a lot lower, the technology was also quite fragmented. And basically, we took the view that that was a really good growth opportunity for potentially for a foreign company to come in and take an advantageous position. Now at the time, you probably might remember, some of you, Vodafone was basically an acquisition machine. We had also Deutsche Telekom had made sort of small bolt-on acquisitions. They'd done the VoiceStream deal a couple of years earlier. And we had NTT Docomo, the Japanese operators, who were potentially looking at building something in the US, as well as this joint venture between the two baby bells, the Singular company. So as I say, we basically thought this was a strategic situation and a scarce asset that somebody was going to take advantage of. So what I'm going to do actually now to stop you people from falling asleep and give you something to do. Basically, I'm not going to tell you the trade that we did. I want you to have a little bit of a think about the trade that you would do. Now, you're going to be using stock and options. So calls and puts. Anybody not know what calls and puts are? Raj, there's a handy seminar later on for you. We'll bring you up to speed. Okay, right, so what I want you to do is devise a trade where you're trying to take advantage of the likelihood of AT&T Wireless being the subject of a takeover bid, okay? Involving stock and options. So I'll give you 5 minutes to do that. Okay. This is what we did, because we like risk. I had quite a punchy boss at the time, so think about that. So long stock, that's obvious. Short out the money puts and short out the money calls. So the stock at the time was trading around I'll go through the sort of chronology of how the situation developed. But the stock was trading around sort of between $10 and $11 because the situation developed over a number of months. But what we did was we went long stock and we shorted out the money puts. So we were shorting, actually I won't tell you the exercise because that's coming later on, the strike price, and we shorted out the money calls. So what do we do? Just in principle, what are we doing when we're selling options? We're generating premium, right? We're generating some income. That's what you need to think about, what you need to remember. We'll get slightly technical later on, but not very, because Raj is going to do that. But we're also doing something with what's called implied volatility as well. So how does that look in terms of a payoff? Now, because it was a slightly unusual structure, all I've got here, this is a covered call payoff. And what effect does that have? It basically caps your upside on the stock, right? So what this shows you is that's the exercise price on the short calls. Basically, if you're just long stock, that's your P&L profile. So obviously, here below the price that you're in at, you start generating losses. Above that price, you start generating profits. Your short call position is that, because basically here, up until you get to the exercise price, you've just taken in your income, your premium, and then as it goes beyond the exercise price, obviously you would start to generate losses. However, because you've got a long stock position to cover that, the actual combined picture is that, the green line, which is your portfolio, long stock, short calls. And all the short put position does is it kind of pivots this line and takes your in price lower. And obviously, because you've generated more income and premium from selling the puts as well. So to give you a bit of background on the situation, we were buying this stock, as I say, we started buying it around the low 10s. It was trading between 10 and 11 when we were buying it. Now, a lot of analysts, now, of course, we all know how useless analysts are, but just to put it into context, a lot of analysts basically thought that the stock was kind of fully valued at 12 bucks. The stock had come from $7.50 and lower, actually. But we took the view that, first of all, you never listen to analysts. No, that's slightly facetious. But we took the view that the reason why the analysts maybe had this one wrong is because this is the last strategic asset in the US wireless sector, right? If you want to get in, you've got to get this company. And there's more than one interested buyer. And we know that. It's all public information. This is not based on a lot of... Unfortunately, a lot of retail traders seem to think that as professional traders, we kind of sit there basically trading inside information. We don't. We get hauled in front of compliance and regulators if we try to do that. So it's generally not a good career move. But it was all public information. Vodafone, acquisition machine. Deutsche Telekom, already active buying US wireless companies. NTT Docomo, the Japanese, you can always rely on the Japanese to overpay. Look at Nomura and Lehman's. And the other US players as well. So this is a competitive situation potentially. There's nothing official announced at this point, apart from at the end of 2003, Singular had made an informal, so unofficial, not released to the market, approach to AT&T Wireless, as a result of which AT&T Wireless went public and basically put themselves up for sale. That's all in the public domain. This is the information that we're working with at the time. So as I say, yeah, it's down the bottom there. Singular, they kicked off the process. That then meant that the other companies that were potentially interested had to essentially break cover. It became clear to us that really the two most likely candidates were going to be Vodafone and Singular, so the US joint venture. And they basically got into a fairly public bidding process. Now, we actually thought that Vodafone would get it because at the time they had, which they only sold a couple of years ago actually, they had a 45% stake in this thing called Verizon Wireless, with obviously the other part of that partnership's Verizon. Now, we thought it'd be fairly straightforward for them to put a cash bid on the table and then basically to get that past the antitrust regulators, so the anti-monopoly regulators. They would do a deal quite simply where they just basically sell their minority interest in Verizon Wireless back to Verizon, and then they're free to take over AWE, AT&T Wireless, without making any disposals. Singular, on the other hand, already had some mobile assets, and so therefore they would need to get into some kind of negotiation with the Department of Justice. So, as I say, Singular made the first bid. The first bid was at $30 billion for the whole company. They raised twice to 35 and 38 billion. Vodafone matched they eventually matched the $38 billion bid. And at that stage, because you had two companies offering the same, AWD, basically a bit like when you buy a house here and you ask for sort of sealed bids, AWE's management said, okay, we want your best and final offers so we can close the process. Vodafone were prepared to go up to $14.50 per share, which was basically about $39 billion. The Singular management thought that that was probably them out of the game. However, they went to their board at the very last moment to ask if they could get permission to submit a $15 bid. And this was, so basically Vodafone they've put on the table a $14.50 bid. They've gone to bed, because this is nighttime in the UK. They've probably gone to bed thinking they've won it. In the meantime, Singular have had one last go at it. They've gone to their board of directors and got permission to bid $15. Vodafone wakes up in the morning, they haven't got it, it's gone for $15 a share to Singular. Okay, you could argue actually from Vodafone's perspective, slightly disappointing. However, they have at least managed to get Singular to pay absolute top dollar. That's interesting, but not as interesting obviously as our position. So this is what we actually had on. So we were long stock, average around 10 3/4. We were short the 8.50 and the 9 puts, and we were short the $15 calls. I mean, that $15 price there, obviously, that could not have got any better. Now, is that because we're geniuses? No. As they say, an old stock exchange saying, better lucky than clever. But we had picked $15, so that going out of $15 was just the home run trade. So why did we do it in that way? Now, you know, you guys came up with some fairly valid alternative structures. So the chap over here was long stock, long puts. The reason we wouldn't do that is because what tends to happen when a takeover situation or an auction situation is announced is that basically implied volatility on the options goes through the roof, because you're suddenly faced with a much less certain situation than you were previously when the stock was just trading as a normal company, just following the normal kind of routine of ups and downs of its share price according to how the business is performing. When you introduce a potential takeover situation, which of course might not happen as well, you then, if you're an options market maker, you're not going to be pricing your options in the same way as you were before that event. And the effect is that it increases the implied volatility, which increases the premium that you can generate by selling options. So basically what this structure did was it got our in price into the position down from $10.75 to around about $10. So we've lowered our acquisition price by about 7%. Of course, we haven't lowered our risk at all. We've actually increased it. Now, the beauty of options is, and we came up with 3 different strategies, and there are more strategies that we could have come up with in the room. The beauty of options is that we can use them, and I'm not going to talk about this a lot because obviously Raj is going to talk to you about that later on. But just generally speaking, the beauty of options is that we can hedge our risk completely if we need to. We can hedge some of our risk, or in this case, we can actually increase our risk, which is what we did by selling the puts. So there's the justification of why we did it. First of all, as I said before, we were getting our average in price down. We also took the view that the implied volatility in those options was basically at a level that we thought was attractive to be shorting it at. Now I'm going to give a very simple description, my sort of Janet and John description of what I think implied volatility is, and then Raj will rip it to pieces later on. But basically, if you have an options price, which is also known as premium, if you subtract from that price what's in there for intrinsic value, the intrinsic value is basically if I have a stock trading at $10 and I'm long $9 calls, I've obviously got the difference between the strike price and the prevailing stock price makes that option in the money. That's the intrinsic value, okay? If I subtract the intrinsic value and the time value, which is basically the time to expiration, I'm left very approximately with another number which equates to the implied volatility. And that's what we were shorting with our options strategy. And generally, as long as we get that right, what it basically did was, obviously it lowered our in price. and it lowered our potential downside if the deal went wrong on a per share basis, obviously not on an absolute P&L basis because we'd have a bigger position. Now I want to talk about, just very briefly, payoffs, because some of you have done the PTM, and even if you haven't done the PTM, you might be familiar with the 1-to-3 or the 3-to-1 ratio. And what that refers to is, let's say if I've got a stock that I'm long of and I put a 10% stop loss limit on that, what I'm on the 3-to-1 ratio, what I'm looking for, so I've got a downside of 10%, what I'm looking for, broadly speaking, is to generate 3 times that, so 30% upside, okay? That's the 3-to-1 payoff ratio. Now, the way that worked in this particular situation, to try and put it into similar terms, now this is all, this is where the social science stuff comes in, because this is not, this is what we do as professionals. It's not an exact science, but we have to come up with some kind of methodology and process, right? So you have to think about, well, what happens if this deal doesn't happen and we just go back to the way things were before? Now, strictly speaking, that actually probably wouldn't happen because you've still got a company that is potentially up for sale. But let's just make it simple and assume we go back to the situation as it was before. Then you're looking at the stock price basically going back to where it was, right? It probably will go actually lower in the short term because everyone's getting out and there aren't many buyers around. So, but on a settled basis, we're looking at the stock price going back to where it was, which was $7.50. So from our in price at $10, that's obviously $2.50 of downside potentially. Now we actually, you remember the analysts were calling this thing fully valued at $12. We thought it would go out for between 13 and 14. So we had, if you think about it, we're then estimating that our potential upside, $3.50 from 10 is obviously a 35% upside. So you're probably thinking, well, 25% downside, 35% upside, doesn't sound so great to me. However, what you've got to also put into that situation is, what do you think is the probability of 750 versus 1350? So i.e., what is the probability, and this is a bit, but it is part of the game, what's the probability of 750 versus 1350? So i.e., the deal not happening or the deal going through and going through at the level that we think it's going to go out at? Well, we attributed a roughly 20% probability to the deal not happening. So basically 20% of the $2.50 of downside equates to 50 cents, right? And then 80% probability of a $3.50 upside equates to $2.80. So actually, if you think about $2.80 versus 50 cents, if our probabilities are correct, of course, big assumption, you've actually got a more than 5-to-1 ratio. So that's how that kind of fits into the sort of 3-to-1 scheme. That's how people, this is basically called risk arbitrage, takeover arbitrage. That's how we look at the world. So why was this such a good trade for us? Well, obviously, the calls expired worthless. We couldn't have done that situation any better. Obviously, the puts went out worthless as well. So we've taken in all that income, and we're long stock at $10, and it's gone out at 15. Great trade. That's it. Thank you.